Well, let's take a look at some of the earnings out today. I've got Chris Gilmour, investment analyst at Absa Investments, joining me. Chris, good to have you with us.
Hi, Sam.
So let's start off with Cumber iron ore today. I mean, the stock is slipping back ever so slightly. Headline earnings per share was flagged that they were going to be under pressure. We knew about the strikes. We know about cost escalations. And I suppose that $122 average iron ore price, I think it was, for the year, was lower than the previous year. So all in all, translating into lower earnings for this year. But for you, what are your thoughts on the company?
I went to the presentation and it was a very, very confident presentation. You know, you've got a different top management there now compared to was a year or two ago. But again, a very confident top management team. And as you say, they put in perspective the fact that it was a tough year. Let's make no mistake. Sishen was a major problem for them. Columella, on the other hand, of course, you see ramping up, coming in very, very nicely up to what, 8.5 million tons.
You've got to take your hat off to them when it comes to production within the Anglo staple, I suppose.
Yeah, exactly. And that's really what it's about. It was actually a good production story, taking out all of those extraneous items. Looking forward, I think the chances are we're going to see a marginally better iron ore price. And I think this is it's a well-structured company, and they seem to be relatively confident that we're going to see a bit of an earnings improvement in the current year. Make no mistake, there's going to be a lot of challenges in the year ahead, coming obviously from the fact we're going to see a lot of new iron ore production coming on in the rest of the world. But nevertheless, I came away from that feeling actually quite good about it.
Mm-hmm. What about the dividends coming in at R12.50? There are concerns that the dividend, still sitting at a 7% yield, is a lot smaller than you would have received in nominal terms a few years ago.
Yeah.
Or just below 7% yield.
7%, yeah. Look, I think with something like this, it's still not a bad yield. I mean, 7% on a stock like this.
So I suppose you have to look at it in context of earnings.
It really is. It's actually very, very good indeed, and it's actually quite a juicy yield. And particularly if you think that, if you believe that we're going to see better earnings in the year ahead, I think it's actually quite attractive.
Okay, so let's move on to Absa. The market knew about the credit impairments, and they know that they've taken some action there, and that of course could be earnings enhancing further down the line. But on the Absa front today, they have lost market share in key parts of their business. That should be a concern on the retail bank front.
Well, you say that. I think if you look at it, the fact that they've taken their non-performing loan coverage ratios up from what, in certain areas of the book, like the legal loan book, for example, up from 17.1 to 28.5, I suspect they realise, it was an old book, and I think they're really cleaning that thing up dramatically. I left that presentation, and one of the nice things about going to real live presentations is you can go and discuss things with people afterwards. And the takeaway that I left is that I think an awful lot of cleanup has gone in the company, and this is something that some observers said, well, they've thrown everything bar the kitchen sink at these results. And yet, I think we're probably now at a situation where they really are poised for growth, not just in the rest of Africa, which is a completely other story, which I think is a very positive story, but I think in South Africa as well. And I'm not just saying that because I'm part of the group.
I know this is a tough one to answer. I know that, Chris.
As I can possibly be, yes.
Yeah. Africa, of course, is going to be earnings enhancing. Even as it stands right now, if they had Africa in their books as it stands, they would have had flat growth.
That's right.
So going forward, just planning to leverage on that. But this deal hasn't quite been approved by shareholders.
Yeah, it's got to be approved. I'm very sure it will be. I don't think there'll be a problem there. That's on the 25th. Look, there was an article in yesterday's Business Day by Stuart Theobald, who was a very well-acknowledged financial writer. And I think he was very, very positive on this one as well. They're going to, the greater group is going to come away after this deal is done, and I'm sure it will be done, looking an awful lot better than any other large South African banking group in terms of the market share in Africa, in terms of the deep-seated knowledge that they have of the African continent. So I think it, from that perspective, it looks exceptional.
Yeah. Okay. And let's move on to Tiger Brands, because just looking at the graph here of the share, I mean 3 p.m. the stock was trading around 308 Rand, and by the end of the day it's trading at around 297 Rand, 4% down on the back of that weak trading update. Seems the market quite concerned about their kind of very weak outlook they are insinuating there.
Yeah, I mean, and I think that's right. I mean, the biggest food company in the country with a predominance of commodity type products in there. You mentioned in the preamble rice, for example, taking a bit of a clap. So I think with Tiger Brands, the fact that they are facing it's going to be a very tough consumer economy, and that has fed into some of the retailers, for example, today. Some of the food retailers, like ShopRite, also down.
They talk about competition, and when you talk about competition, one could extrapolate competition, rising costs, margins still a problem.
Yeah, absolutely. If you look at the kind of pressure the consumer is under at this point in time, Eskom may not get its 16% that it's looking for. I hear a figure near 9 or 10%. But even so, the consumer is such an intense pressure with a weaker rand in terms of fuel costs that the ability to buy a lot of those value-added products within the Tiger stable is going to be limited. And one of the things that Tiger has done in recent years, they've kind of shied away. They've been very reluctant to get into the what can I call the house brands market. They'd much prefer to stay with their own well-known, tried and trusted brands. Nothing wrong with that. But I think there's a movement taking place in South Africa, as it has in the rest of the world over many decades, that consumers are looking for much more value, cheaper brands, house brands, and Tiger's not that well positioned in this market at all.
And it has continued to be a problem for them. Do you think that they could ultimately take that decision to perhaps even cannibalize their own brands by starting to manufacture house brands?
I think a lot depends on how long consumer spending remains under the kind of severe pressure that it currently is. If it stays like this, I think the demand for generics, as I would call them, will become far more intense. I mean, you look at ShopRite a couple of years ago, Whitey was on saying quite categorically they're looking to go overseas to try and source a lot of these house brands because they can't get them made here. Excuse me. So if that happens, I think Tiger will be forced, as you say, reluctantly, to get more into that market.
Let's talk about Spar. Spar also coming out with a trading update. So much to get through, and I don't know if we'll get through all of them, but Spar for the 17 weeks to the end of January 26, turnover up 10.7% to 15.8 billion rand. Interesting that they talk about volume growth there, which is of course positive.
Yeah. 10.7 in the context of what we've seen from the food retailers, actually not bad at all, and actually quite reasonable. Spar, they've been quite clever in the sense that if they perceive a franchisee is faltering and they might be a target for, let's say, for example, just plucking a name out of the air, Massmart, they jump in there and say, no, let's ring fence that, we'll buy it back, and we'll make sure that another franchisee can take it up. So they're kind of warehousing it. They realize that the pressure out there is very, very intense indeed. So Spar, it's a different type of model to the other two big ones, should I say. It's much more a distribution model, but hanging in there actually quite nicely.
If you talk about distribution, it almost goes to Supergroup, which is a logistics company. I mean, any interest in that stock at all, given the fact that overall earnings are looking good, interim headline earnings per share up 19.4%, revenue also up, and they've also had margin expansion there.
Yeah, look, I mean, if you go back 2 or 3 years, this thing really was taking immense strain. And a lot of people at the time, thought it was good value. We've tended to say, look, let's rather sit and wait and see if we get that sustainable momentum coming through. It appears to be happening at long last. It's taken quite a while because they really were in the doldrums a few years ago.
And what about Cumber? Because Cumber has been in the doldrums and managed to return to profitability from a loss of 34 million the previous year. It's making a profit this year of just under 80 million rand. Does that mean that perhaps it could be one to look at and add to the portfolio?
Given the fact that their biggest single input cost is the fuel price, and we were mentioning earlier what's happened with the rand price of fuel, and it affects airlines as well. They've done incredibly well to come up with results like this. I think a lot of it is due to the fact they've got a more efficient fleet. They've bought 4 new Boeing 737-800s in there, much more efficient than the older planes. I think simple things like substituting the Woolworths food that they used to have on board with their own food in terms of their own catering, that's helped. They've obviously they put food under the microscope on all costs generally, and it's having a big effect, I think. That's a massive turnaround to go from minus 4.9 to plus 16.4. I mean, that is quite incredible. And look, it's still...
But the question is, to buy the stock or not, or hold the stock if you've got it.
We've tended to avoid the airline stocks, not because they're badly managed, far from it, they're very, very well managed, but these are terribly volatile stocks, and you really have to have nerves of steel to be in these ones.
What is the big theme you're looking for right now when it comes to earnings this period?
Yeah, well, I think the big theme so far has definitely been that if you miss your earnings even by a few cents, you're going to get slapped down very, very heavily indeed. Look, we're going to start, we're getting Woolies coming out on Thursday. That's going to be fascinating. It's going to give us a really good feel as to what's actually happening under the surface of food retailers at this point in time. And as we mentioned earlier, I think consumer is going to remain under severe pressure. But Woolies, I think, will give us a good guide to what's happening because it's a hybrid. You know, it's food, it's clothing, and of course it's financial services. So that'll be truly fascinating. You know, we're only 6 weeks into the year. Themes take a little bit of time to build up, but you know, some results really are surprising on the upside, others marginally on the downside. Overall, it's actually looking a bit better than we would have thought maybe 6 weeks ago.